The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Tuesday the 21st, 30 to the close. What do you need to know out of Europe this hour? Well, buying the dip seems to be fading a little bit. European stocks bounced earlier from yesterday's sell-off. We're still higher, but we are off our highs. The Evergrande story is present. We're waiting for the Fed story. Remember, Evergrande apparently, according to Bloomberg reporting, missing some payments to banks yesterday. The UK's debut green gilt drawing massive demand. But is London actually late to the party? We're going to speak to the Chief Secretary to the Treasury, John Glenn. Shell surging as it offloads its Permian shale assets to Conoco Phillips. $9.5 billion. The price tag, 3/4 of that money, roughly $7 billion, is going to go back to shareholders. That's why the stock is up as much as it is. We're going to be joined by the Conoco CEO, Ryan Lance. Let's look at the markets. Let's talk about some of the other stories we're focusing on as well. So European stocks are off their highs, but we're still positive, unlike what we're seeing on the S&P. There are some individual stories that are worth focusing on. I mentioned Shell. Let's talk a little bit about what's happening with Entain as well, the UK betting company. Apparently, and this has been confirmed over the last few minutes by the company, it has received a stock and cash proposal from DraftKings of the United States. It is urging that no action is taken. But as you can see, stock's up quite nicely on the back of that. 18.25%, Alex.
Yeah, it's like M&A Tuesday. All right, so here we're definitely seeing some tempered enthusiasm here. So S&P now flipping negative, as Guy was just pointing out, down 0.2%. The safeties like healthcare, for example, utilities, they're really contributing to the upside. Just want to skip home building for just 1 second. You are seeing money come into the bond market. We're still kind of sitting, though, at 130. So not a lot of movement, but you have to wonder if some buying is going to pick back up if we continue to roll over to the S&P, particularly into the close. That would be pretty ugly, particularly after yesterday. Crude down 0.7%, so everything kind of a little bit heavy. I did want to point out the home building index, because you did have housing starts for August that did come in higher than estimates. But Lennar reported revenue yesterday that talked about the supply chain issues. They can't build the house if they can't get the stuff to build the house. And that overall index down by over 1%. But, Guy, it's going to be tricky for large positions to be taking place as we had that big sell-off yesterday, kind of into the Fed tomorrow.
Absolutely. The Fed is a pretty dominant theme right now, and one of the factors, obviously, that the Fed is going to be considering right now, talking about it, the global inflation spike, fueled, as Alex says, by a range of things: high shipping costs, raw materials prices, labor inflation. All of these things potentially could pose near-term risks to the economy, potentially long-term risks to your portfolio. This is all according to the OECD's latest interim outlook report. The OECD's chief economist, Laurence Boone, spoke to Bloomberg a little earlier.
What we need is at least two things. First, indication on the sequencing, and second, indication on the conditions, the economic variables, the evolution that will make those policymakers move. And the last thing is, fiscal policy, super accommodative, will not last forever. We have climate to address. This will require resources. So governments need to plan now on how they will adjust in the future, in a year or so, for addressing those challenges.
It's JP Morgan Asset Management, International CIO for Fixed Income, joining us now. Is the bond market adequately pricing the risk when it comes to inflation? We were talking to CalPERS a little bit earlier on. I look at what is happening with pricing here in the UK, on the continent, in the United States, and it still feels incredibly optimistic in terms of what potentially could be priced when it comes to the inflation outlook. The OECD raising its forecast today. We've heard from the ECB as well, talking about the raised forecast in terms of what they see. They're alluding to the fact that inflation is maybe a little stickier than than we thought even a few weeks ago.
So I think it's a good question. I think it depends what part of the bond market you look at, because if you actually look at where break-evens are trading, in the US, we're sort of 235 to 250. We've been at points over the course of the summer. The UK, we've got a 3 handle, approaching 4. So you could argue the break-even market saying, yes, there's some inflation coming, but it's those really, really low real yields, deeply negative real yields, where the bond market's probably just challenging exactly what's going on. And it does feel a little bit of a disconnect, because I would agree that, yes, we know it's going to be transitory. We know there's been sort of used car prices that have picked up inflation numbers in the US, and they have to come back down at some point. But when you look at things like wages, when you look at the shelter component and some of the high-frequency shelter data in the US, it looks like it might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
So how long until we know that? Because there are some stickier stuff as well. I mean, even in commodities, which I know economists wind up looking through, but a lot of the changes that we're seeing, say, in the power market, they're structural. This is a structural shift. It's not necessarily just a short-term supply issue.
So I think the most important thing that the central bankers, whether it's the Fed, whether it's the Bank of England, will be looking at is the wage data and how wages pick up. And we need to get over the period of the Employment Protection Plan. We need to get over the furlough scheme here in the UK, and then give it another couple of months, probably a little bit sooner for the US, maybe towards the end of the year, beginning of next year for the UK, and see what these numbers are looking at. How healthy is the jobs market? And are we seeing still this lack of supply of labour and a big demand for it, which is offsetting that? And I think that's when the central bankers will start to get a better picture as to what exactly is going on, and maybe they need to react a little bit quicker than they're currently predicting. But for the time being, they're probably happy just to stay the course and wait.
I want to go back to a conversation that happened a little earlier on Bloomberg Television between Tom Keene and Ray Dalio. And Ray Dalio was making the point that each economic cycle we go through, interest rates peak at a lower level. And that's been something that we've gone kind of from Volcker all the way down. Basically, that's what's happened every economic cycle. And the QE, every time we've used it, has got bigger and bigger. Are we at a point where that is going to stop, i.e. the inflationary debate we've just been having will actually cause peak rates to be a little higher this time round, and as a result of which, when we come to use QE again, which we inevitably will, actually the size and scale of it will be smaller? I'm wondering whether or not we're reaching the bottom in monetary policy in terms of where rates are going to end up, and actually this time round, because of the inflation that potentially could be stickier than we've seen really for quite some time, actually the rate cycle may be a little bit higher. Where do you think peak rates, for instance, in the UK will be this time?
So I think the difficulty we've got here is the debt burden. So we've issued a whole load of debt, and when you think about it from a central banker's standpoint, you do not want rates to be particularly high, because you've got to fund that debt and you've got to continue servicing it. So you do get this sort of financial repression which keeps rates low. So although we've had this huge QE program which pushed it down, and we are going to step away, I think it's going to be a long...
So we could end up with inflation quite high, but rates quite low because of the debt burden. And so basically that's stealing from investors. And
if you look at what the bond market's pricing at the moment, as I said earlier, that's exactly what the bond market's saying. We've got those break-even levels, yet we've got those deeply negative real yields at the moment. So the bond market is saying rates need to stay low because you need to finance this debt, but it's also saying actually there is going to be a little bit of inflation out there. So the deep negative real yields is probably what gets us out of this big debt burden that we've built up over the last year, or really started since the financial crisis, but has been exacerbated by the pandemic.
So is this a stagflation view that we're going to be taking in the medium term?
I don't think it's necessarily a stagflation view, because I think you're going to get reasonable growth at the same time as you get the slightly higher inflation than we've had over the last decade or so. I just think central bankers are going to be prepared to allow that inflation backdrop to be a little bit higher than maybe we would have thought previously. They seem to, at least governments seem to have become less concerned about deficits and debt burdens, and are happy to try to grow our way out of it. So I think austerity is behind us from what we knew in the financial crisis. We're going to have the support of governments, the support of central banks, and it's going to be a combination of low yields but with growth that's going to get us out of this.
German election this weekend, what's priced?
I think it's pretty much an SPD coalition with probably the Greens and the FDP, get my acronyms right. I think the market has got that in the price to some extent. So actually, interesting enough, in the last couple of weeks, some of this sell-off that we have seen in bond yields has been led by Europe. But what's going on in Germany, what's going on in the UK. Possibly once we actually get the final formation of it, maybe there's a little bit more weakness left in the German market, but I think a lot of it has already been priced.
Is there an implication from the gas crisis that we're seeing in the UK right now, in Europe right now, for the bond market? And if so, what is it?
So in the UK, we've obviously got kind of the stabilizers from a consumer standpoint, so it's not going to be as dramatic. I think we've heard this morning that some of the smaller companies that might be challenged, shall we say, will get some form of support. I think this is the wrong type of inflation. Bear in mind, this is a tax on the consumer, and I think again the central bankers.
It's a drag on growth. Is it?
That could well be a drag on growth. So again, I think the central bankers will want to effectively look through that. They're not going to be raising rates in anticipation of higher energy prices. That's not what they want. They want it based on things like wages. That's what they really want to see.
So not a 2008 scenario. Hey, Ian, before we let you go, the UK issued some green bonds. I mean, insanely oversubscribed. What do you make of how this market develops? Like, are they good investments? You're going to pay a premium, a greenium, as people are calling it. What do you think?
There's just been a huge demand for all sorts of green bonds over the course of this year. We've seen that even though that a lot of them have come with greeniums, they've still done very well on the break. We've seen huge demand for them. I think what we have 90 billion sterling, a record demand for the green bonds today. We're going to see another green bond from the UK later this year in a 30-year part of the curve. I wouldn't be surprised if there's record demand for that as well, and probably allowing them to maybe do more than the 15 billion that they set out to do earlier this year.
Ian, we're going to leave it there. Great to see you. Great to see you in the studio.
Great.
More importantly,
Thanks for having me back.
Yeah, fantastic to have you back. Ian Stealey, we're going to be speaking, and Ian was just talking about it, about that green bond story with John Glenn, the Chief Secretary to the Treasury, a little bit later on in this hour. Alex, looking forward to that conversation. How much further does it go? Is the UK green bond as green as it first looks? That's worth discussing as well.
I don't think anyone knows, but we'll break it down. All right, coming up on the program, Conoco Phillips, $9.5 billion deal to buy Shell's Permian Basin assets. We're going to talk exclusively with Ryan Lance, Conoco Phillips Chairman and CEO. How did this deal come about at this price? This is Bloomberg. A huge deal, a second huge deal for Conoco Phillips, agreeing to buy Shell's Permian Basin assets for $9.5 billion, making it one of the largest Permian producers right now in the U.S. Now, this just comes a few months after Conoco bought Concho for almost $10 billion as well. And this is where Conoco sits right now. You're looking at about over 430,000 barrels of oil a day from the Permian with the Conoco and Concho combined. Now, you have to add as much as 200,000 barrels of oil a day in 2022, which is what Conoco thinks it can do with Shell's assets. It's a lot of oil, it is some natural gas, and it is a lot of acres. So joining us now for an exclusive interview is Ryan Lance, Conoco Phillips CEO. Ryan, we really appreciate the time. Congrats on the deal. It was rumored from Bloomberg reporting that Shell wanted to offload these assets because it was so expensive. It was going to be hard to find buyers. How did this deal come about, Ryan, and why now at this price?
Well, thank you, Alex. Appreciate the opportunity to chat with you today. It came as a bit of a surprise. I think Shell made a decision to put the assets on the market, and I got a call about the mid-year saying, would we be interested in taking a look at them? And it's consistent with our strategy, consistent with where we're at and what we're doing, contiguous, and with the acreage position that we've developed after the Concho transaction. So certainly we wanted to go take a look at it. And then ultimately, most importantly, it had to fit really three things within our company. It had to fit our financial framework, which we laid out pretty clearly to the market back in 2019, and it did that. Could we see it clearly that we could add value to it? And we can after the Concho transaction and bringing our two teams together, we see ways to add significant value to the transaction. And thirdly, it's got to make our company better. Mm-hmm. And that's what we outlined today in our press release. When you look at our 10-year plan, this is accretive to just about everything we look at in our plan, and it makes us a better company. So we were clearly very, very interested when it came to the market, and we're really, really pleased to be able to transact with Shell.
You obviously clearly had the cash. I mean, you had a great balance sheet, oil at this price, you got a lot of free cash flow. The deal did come in higher on a per net acre basis and a per flowing barrel basis than your Concho deal. I appreciate that oil prices are up since your Concho deal, but some are saying that that is too high of a price. Maybe you paid a little bit too much. How did you come to the right valuation?
Well, that's what's great about our cost of supply framework inside our company, because it's agnostic to price. So to fit our framework, Alex, the all-in cost of supply needs to be below $50 a barrel WTI, and the future investments need to compete within our portfolio at a cost of supply less than $40 WTI. So we didn't evaluate it at today's prices. We looked at it to make sure it fits our cost of supply framework, and then we felt like we paid a fair value for the assets based on that cost of supply framework, which is all in below $50 WTI. So it really is agnostic to what the price is doing today. It represents our long-term mid-cycle view of prices. We need to make sure it fits our framework about how we allocate capital at the highest level. And it does at this kind of a purchase price.
Yeah, so then on that, this is like a longer-term strategy question, Ryan, because something that Conoco does is you guys do things before the rest of the industry does. So when you guys were already sort of regulating your CapEx, you were paying out more buybacks and dividends, the rest of the industry was not. They were outspending their cash flow. Then when you kind of cut your payouts, you did it first before the industry. So the fact that you have to raise your CapEx and you bought 2 huge deals, what is that telling me about how you, Ryan, see the industry and a potential super cycle or a supply crunch coming up?
Well, I think we're pretty bullish on the next couple of years. We think the supply and the balance in the market, the restraint that the OPEC or OPEC Plus group has put into the system, the recovering demand that we see coming out of the world today post-COVID pandemic. We see the demand improving. We see probably getting back to pre-pandemic levels by the end of the fourth quarter into the first quarter of next year, and the market getting relatively balanced. And then there's been discipline, as you point out, on the U.S. and the E&P investors, which is what we've been following for the last 4 or 5 years. We think that's important. We still see that discipline. So we're pretty constructive on the price going forward. But in our kind of view, the world is going through an energy transition. There's going to be increased demand for the product as we go forward. So we want to be in the best basins and the lowest cost supply basins around the world, and that's what the Permian Basin represents. We've got a very stated strategy to be really, really driving the company and its portfolio to the lowest cost of supply so we can continue to meet the demand in a transitioning world. And that's going to be really important. We have what we call a triple mandate. We think that we have to meet that demand in a transitioning world. We have to do that reliably and affordably. Second, we have to make sure that we're getting adequate returns of and on that capital that we're spending so investors will invest in this business. And then we have to do it sustainably. We have to take care of our Scope 1 and Scope 2 emissions, the emissions we create as a business, to make sure that we're doing that over in a Paris-aligned climate risk strategy. We were the first E&P company to come out with a climate risk strategy that was aligned to Paris. So we'll reduce our emissions. And in the announcement we made last night, we're increasing our target with our emission reductions plan associated with the combination of these assets.
Ryan, let me jump in. Good morning, it's Guy.
Good morning, Guy.
Can I take you back to the point you just made about investors and how they'll be feeling about this deal? What do you say to, and I'm sure there are some, those investors that say, you know what, we'd rather have had the cash flow returned to us. That is why we're investing in this sector right now. That's why we're investing in Conoco Phillips. You've gone out and bought some acreage. We'd rather we had that money in our pocketbooks rather than you going out and spending it. What do you say to those investors?
Well, I'd say, this acquisition underpins our financial commitment to the market, and it delivers free cash flow. It's immediately accretive on all those kind of metrics: free cash flow yield, earnings. And so we're taking that money, we're investing it over the course of the next 10 years. We already showed how it's accretive to our 10-year plan. It delivers that and more back to the shareholders over that 10 years, and that's at $50 WTI prices. At today's prices, the shareholder gets a return and then some on its investment in half that time. So this is what we do. This is what we're really good at as a company. And I think investors should want us to be making these high-valued, accretive kinds of opportunities because it makes our plan better over the next 10 years. It makes us a much stronger company doing what we do really well.
Some investors may have looked at this deal and thought, hey, I thought these guys were focusing on Alaska rather than the Permian. Is this a zero-sum game? Is a deal in the Permian a deal kind of against what is happening with you guys and your acreage in Alaska?
No, Guy. This is, we strongly believe in a global diversified portfolio. It's one of the strengths of our company, and it's one of the differentiating attributes of our company relative to our E&P competitors and our peers. So it lowers the capital intensity by having these large legacy positions in places like Alaska, Norway, Canada. the Far East, Australia, Qatar. Those things just add to the capability of the company. They lower the decline rate of the company. They stabilize the company, less capital intensive kind of business, lower the decline rate. So we strongly believe in maintaining that global diversity, but we got to make sure that it's low cost of supply wherever we're at. And the things that we're doing up in Alaska complete favorably in the portfolio, whether it's Permian or our other Eagle Ford positions or any other opportunity we have around the world. That's the great thing about our cost of supply framework, is it makes sure we're doing the best things to get the best returns on the capital we're spending.
Ryan, real quick on Alaska, and you're not going to want to answer it, but what is your level of confidence that you get to do what you want to do in Alaska?
Well, we expect to do what we're wanting to go do, Alex. This is nothing new to us. This has been our 40-year, 45-year track record in Alaska. We know there's some differences of opinion, but when you look at the operations that Conoco Phillips operate in Alaska, we've been there for nearly 50 years. We do it right in Alaska. And it's really important to the state. All our stakeholders are supportive and behind what we're doing up there. A federal judge on the Willow Project asked a few questions. There's remedies, there's solutions to those, and we're working through those. And we expect to work through those in a way that will satisfy the questions that the judge has and make for even a more robust permitting process that we've already been through on the projects that we're developing up there. And I remind people that we've got a project coming on at the end of this year called GMT2 in Alaska. We've reinstituted a number of rigs that are drilling up there, and we're still operating and still investing capital up there that's very, very competitive in the portfolio.
Before we let you go, I want to take you back to the Shell acquisition. On the call and in the press release, you made some pretty very specific targets that you said a 15% growth rate, a growth target for the Shell assets in less than a year. You also upped your emissions for Scope 1 and Scope 2, the intensity reduction target as well. What are you going to do that's so different than what Shell did?
Well, I think it's going to apply the efficiencies, the technology, the learnings of our companies. We brought the Concho, and you mentioned that in your opening remarks, brought Concho and Conoco Phillips together. We've created a very efficient machine in the Permian and across our whole lower 48 operations. And we're really proud of what they're doing. They're really attacking the technology and the efficiency side. We already see some ways that we can improve upon what Shell was doing. And Shell was doing a good job out there. They just didn't have the size, scale, and scope that we do. And we've got a much larger position. We're able to bring some of those learnings across the Eagle Ford, the Bakken, and what we're doing in the Permian together to make the assets much better. And that's an important driver in this acquisition, is we know how, with our commercial acumen and the technology that we're deploying, we know how to make the assets even better. And that's what's exciting to us.
Final question from me. We're not going to quite let you go just yet, Ryan. The Qatar Northfield, does this deal have any impact on your aspirations there?
No, Guy. I think we're well placed in Qatar. We've been there for a long time. We're a participant in one of the large mega trains at Ras Laffan, and we're competing with a few other companies to secure a position in the expansion project as well. So no impact at all. Again, it goes to sort of the global diversification of the company. We invented some of the LNG processes 50 years ago up in Alaska. We have our own proprietary technology. We know the LNG business really well. We know the customers really well, and we're pretty bullish on LNG markets going forward over the next 20 and 30 years. So it makes an amount of sense for us to be in the middle of that. But again, whatever we do there has to fit our framework. And if it fits our framework, we're happy to move forward very aggressively.
All right, Ryan, listen, thanks for being so generous with your time. We super appreciate it. Congrats on the deal. Ryan Lance, Conoco Phillips, Chairman and CEO, joining us there. That stock up over 2%. All right, let's get more insight here on the European side. Christian Malik, JP Morgan, head of EMEA Energy Equity Research, joins us. He has an overweight rating for Shell. Hey, Christian, a lot of money from this is going to go to buybacks. Is that a good use of this money for Shell?
Yeah, I think it's interesting listening to Ryan just talking about the priority around volume growth, ultimately, being used to leverage it through kind of a higher oil price. And in the case of Shell, it's almost sort of the contrast that they're prioritizing cash and cash return over barrels. In other words, they're willing to sell their acreage to fund more returns, and in some ways, having already set out a buyback, as they've got 20-30% of their cash flow in the form of cash return. this additional $7 billion that they're going to use or source through the sale is going to be on top of that buyback, which tells you that the company's priority is really now firmly in winning back the shareholders after having cut the dividend.
In terms of who got the better end of the stick here, we were just obviously talking to the Conoco Phillips CEO. His perspective is obviously that this is a great deal for him. Is that your perspective as well?
It's interesting. It's almost like a mutual, this is probably one of those deals where actually everybody wins, because COP's looking for more acreage in order to leverage an upcycle, whereas Shell's looking for a high grading in where it can actually add value in deep water. And as they've said themselves, that the Shell Permian position, they've kind of got it as far as they can. It's subscale, and therefore they're going to invest more. It'd have to be significant. And I think the interesting kind of takeaway in terms of this mutuality is that both of them are remaining disciplined on CapEx. It's just having to sort of shift and sort of move their assets around in their portfolio, basically rationalize where they can add value the most. In both cases, in Conoco Phillips, it's shale. In Shell's case, it's actually the deep water, where it's likely that's where they switch that CapEx into.
So, Christian, what else do you think then Shell's going to do as they really try and pivot, transition, they get out of assets that they have to pump a lot of money into? What's next on their chopping block or their list of development?
Well, it's interesting now that we've sort of formalized the fact that Shell are actually happy to sort of rationalize their portfolio. Don't forget that Shell is actually one of their core positions. It sort of puts a spotlight on the non-core positions, but equally, it's likely that within the sort of acreage that they have, that I think from an ESG perspective may not sit as well. Nigeria is something that they've talked about. I think some of the kind of conventional oils fields, where again the S and the G may not screen as well. I think what you'll see Shell do is high grade, not just around extracting value, but where actually it works from a carbon intensity perspective. And it's interesting that this morning we've had very little from investors on what it means for Scope 1 emissions as a result of this sale. In fact, I think it's actually quite high up on Shell's agenda.
Well, no, it must be high up on their agenda. They've had a court ruling that basically says they've got to reduce their emissions. And I'm wondering, as the landscape changes, how we should think about these energy companies. Is that going to be repeated? Are other courts going to make similar demands of oil companies going forwards? And if so, how should we think about, as you say, the kind of the shuffling of assets that is likely to take place?
It's interesting, you're seeing assets rotate, but in fact, I mean, Shell's sold its assets to Conoco Phillips. So is that really solving for a reduction in carbon intensity on a global scale? Probably not. Obviously, Conoco are going to do lots of work in terms of reducing the carbon intensity further. I'd actually think that one of the areas that I think the pushback is that we've seen is this rotation away from oil and gas just when oil and gas prices are firming up. In fact, we've sort of worked on something recently, which just sort of comes back to know your customer. What do investors actually want? And I know, Alex, we talked about the oil price going up and the share price is not responding. And in fact, it's outsized exposure to oil and gas, if you think of it as a barbell, as well as a viable transition strategy. And I think even on the latter point, it's not enough, Guy. I think what they also need is to crystallize value through farm downs, be it oil and gas assets or renewable assets. So I think the common denominator in this kind of like energy kind of strategy is harvesting cash and cash back to shareholders as a way to give them the yield that they need, particularly given the risk premium they're taking.
Christian, thank you very much indeed. Greatly appreciated some analysis straight after our conversation with Conoco Phillips. Christian Malek joining us from JP Morgan. Shell, a huge feature of the landscape here in Europe. We're wrapping up the session. Actually, Europe still looks fairly buoyant compared with what we're seeing over in the United States, and it's being delivered, this pickup today, on reasonable volume. Yesterday, obviously, a big down day, again, on reasonable volume. In fact, quite large volume yesterday. So we've bounced back a little bit, so more of a turnaround Tuesday on this side of the Atlantic than more the tepid picture we're seeing stateside. So quite a lot of bright green. The CAC's up by 1.3. The DAX is up by 1.2. The FTSE 100 up by nearly 1%. Shell, obviously a feature of the landscape here, but actually it's the travel and leisure sector that is really leading in terms of the gains that we're seeing. Obviously not the weighting factor, but nevertheless, obviously some gains being delivered. So a much brighter picture on the European side of the Atlantic. Let's take a little look at how the session has developed. This is the Stock 600 as we've come through. A pickup first thing, a gap high. Yesterday it was a gap lower, and then just a cruise sideways, really. Not much volatility mid-session. Certainly not when the US came in and rolled over a little bit. We did see a little bit of a downturn, but it was quickly kind of stabilized. So in aggregate, the Stock 600 in today up by around 0.9%. Let's break it down from a sector point of view, just to give you an idea of what is happening here. This is the picture, largely green once again. I mentioned what's happening with the travel and leisure sector. Retail's picking up a little bit. Sorry, real estate's picking up a little bit. Technology, energy, Shell is up by 1.42%. The luxury sector, which has been so concerned about what has been happening with the Chinese story, also bouncing back. There are some losers still. The basic resources sector is still down, so the miners are seeing a little bit of weakness. Media's down a little bit as well. Retail just giving back some ground. But let's talk about some of the individual names, because there's certainly some interesting ones today. Royal Dutch Shell up by 3.35% on the back of that Conoco deal. Huge return, a surprisingly large return to shareholders. They're going to get 3/4 of the 9.5 billion that is the price tag for that deal coming back. Remember, effectively, in some ways you could argue that Shell was a forced seller. Vivendi, we've seen the spin out of Universal Media Group. Its stock trading up by 12.8%. The UMG deal, the UMG float, seems to have gone significantly better. That's been priced back into Vivendi. And then there's the story that kind of finishes up the day here. You've got this DraftKings deal, which looks like has been made at the moment. Entertain is saying take no action. It's a stock and share deal at the moment. We're trading up by 18.4%. We'll wait and see exactly how that deal crystallizes, but certainly the juggernaut that is US sports betting seems to just be getting, Alex, stronger and stronger and stronger, and we're seeing some of the stronger parts of that market just hoovering up assets right now. The consolidation process, the roll-up process, firmly underway. Entain up by 8.4%.
All right, let's get to a market that's stronger and stronger and stronger. That's the green bond market. Now, I remember years ago I tried to get the segment on TV and I had to wait till the end of August when no one was around to do it. And now it is truly front and center. So today the UK raised about £10 billion for a green debt maturing in 2033. That is a record for green bond sales. But what was so interesting is it attracted over £100 billion of orders. That is an insane subscriber rate. And here we look at sort of where the green bond issuance landscape has come globally, I should point out. So this is where we are in 2020. This is where we probably will get to in 2021. We're looking at already $391 billion of deals. That's just going to grow. It's going to grow 2022 and 2023. There are questions, though. How much of a greenium are you willing to pay? That's the premium over what you pay for a normal issuance. And also, what are the qualifications? How do you know if it's really green? And how does that market then develop in the internal workings, Guy?
Absolutely. There are going to be investments in carbon capture. There are going to be investments in blue hydrogen. How green are some of those endeavours? John Glenn, the UK Economic Secretary to the Treasury, joining us now to discuss. John Glenn, good afternoon. Thank you very much indeed for your time today. Look, this is a huge amount of demand. We're wondering what comes next. What does this mean, A, in terms of your expectations for issuing green bonds going forward? I'm assuming this encourages you. What does it mean for the British taxpayer?
Well, I think this is excellent news. This is the largest sovereign bond issuance ever. And the demand, as you pointed out, has been significantly above many people's expectations. And there is a premium, really, for a greenium, really, for the way this has worked. We will be issuing further bonds subsequently next month, and we'll set out more details of that at the budget next month. But I think it demonstrates the appetite that's out there in the markets for a authoritative and well understood mechanism to fund some of the interventions that will get us to our net zero goals.
Are you considering other sustainable debt formats like a sustainability linked bond as well? And can you walk me through the thought process?
Well, what's really clear is that people need to have confidence in where this money will be invested and need to understand what disclosures go with it and where there's some guarantees on where this money is being used. And so we're working hard across different jurisdictions to ensure that we've got these sorts of disclosure environment that actually gives people confidence in the markets. And that's something that we're working on as we move forward to COP26.
Some argue that the UK is actually not being as green as others, actually that it's behind the curve as well in terms of its timing. What do you say to those people? For instance, is blue hydrogen a worthy investment here? Is carbon capture actually going to deliver the kind of benefit we need for the environment, given the scale of the investment that is going to be needed there? Are these investments green enough, really, to justify the green gilt label?
Well, clearly, we haven't been the first sovereign to issue, but what we have done is made sure that when we have done so, people are very clear about what it will be invested in. Now, I recognise that there are discussions about the sustainability of many underlying technologies, but I think what we've got is a consensus on what this means at the moment. We will be making clear disclosures through this process, and people will be able to know where it's going. What I can't do is predict the full extent of technological developments with respect to dealing with alternative energy supplies. But what we will do is work with the markets to ensure that when we do further issuances, there will be clarity and confidence in what we issue and how it can be deployed.
Can we just talk about the budget you just mentioned a moment ago? Because the financial sector in particular, I'm going to slightly switch subjects here, is fascinated what could be in that. The Chancellor has said that there is a review ongoing into the bank surcharge. And we're now wondering whether or not that is going to be something that we can expect the result to be announced during the budget. And for instance, can we expect within the budget to see some sort of offsetting of the increase in corporation tax that we're going to see maybe when it comes to the bank surcharge? The financial sector is agog with anticipation on this, John. Are we going to get some news in the budget?
Well, I'm to advise the chancellors to decide. The budget will come very shortly. But what I've always been clear, and the Chancellor was clear in his Mansion House speech, is that we need to look at openness, green. We need to look at the application of technology to financial services. But above all, we need to look at competitiveness. And clearly, given the changes to the corporation tax rate, we need to give certainty to financial services institutions. And so I'm working very closely with him to ensure that we can bring that clarity as soon as possible so businesses can plan into the subsequent tax years. But you'll just have to wait and see a few more weeks.
We've seen a lot of bankers pack up and move to the likes of Paris, for example.
Not that many.
I'm sorry?
Not that many.
Some, a few. What I mean to say is that it's a very competitive landscape, especially keeping talent at home. You guys have a cap on bankers' bonuses, and I wonder if that's a rule that you consider scrapping in order to keep some of the talent homegrown.
Well, we've seen modest movements to other locations in the continent of Europe. And obviously, we look at that competitiveness. We look at what is the best framework for us to attract more investment into London. And that covers a whole range of areas. And that's why we've got the wholesale markets review. We're looking at how listings can be done on London markets. We've had a record year for best year for, I think, 7 years in terms of issuance. So there are a number of things that we can look at. But we do that within the framework of high standards. We're not racing to the bottom. We're not deregulating for the sake of it. And I think that's a really important message, that London means high standards, but an open and competitive environment that allows businesses to prosper and grow their global footprint.
How much is it going to cost the UK Treasury to keep the lights on in the UK this winter? What effect do you think high gas prices are going to have on economic output? This is going to be a drag not only for the consumer, but also for industry. Well,
my colleague, the Business Secretary, Kwasi Kwarteng, and the Chancellor will be having meetings today with energy companies looking at some of the options. But the Secretary of State has given reassurance to Parliament. These are obviously complex matters, but we will be looking to do what's necessary to give the markets reassurance and to give consumers reassurance as we move forward in the coming weeks. But those matters are under discussion live now, so forgive me, I can't offer any commentary from here.
John Glenn, the UK Economic Secretary to the Treasury, thank you very much indeed for your time. Okay, we wrapped up the session here in Europe for equities. A little bit of movement during the auction process, but not much. Actually, a fairly stable session after an initial gap higher. We have seen a number of interesting stock stories, though, that have impacted the market. Shell is certainly one that stands out with the Conoco Phillips deal and the huge amount of money that is going to be going back to shareholders. Entain is another one that we're watching quite carefully, and that bid, it seems, that has come through from DraftKings. The company advising no action to be taken at the moment, but the stock certainly rising significantly. The DAX up by 1.43%, hit hard yesterday. The CAC bouncing back by 1.5%. So a little bit more stability on this side of the Atlantic. We'll watch carefully to see how the US closes a little bit later. This is Bloomberg.
This is Bloomberg Markets European Close. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Anna Ashton, US-China Business Council Vice President, 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. British Prime Minister Boris Johnson says President Biden has too many domestic priorities to find time to negotiate a trade deal with the UK. The two leaders meet today in Washington. A trade agreement with the US was billed as one of the prizes of Brexit. Johnson says he would rather have a good deal than a quick one. House Democrats are taking a risky move that assures a potentially damaging showdown with Republicans. They will include a suspension of the debt ceiling in a spending bill needed to keep the government open past the end of the month. Republicans have already said they won't vote to raise the debt limit. All this could be leading towards a government shutdown at the end of the month. New data suggests that a booster dose of Johnson & Johnson's coronavirus vaccine increases the potency of the one-time shot. The booster was 100% effective against severe disease when given 2 months after the first inoculation. A second study found that the additional J&J shot led to a 12-fold increase in the production of antibodies when it was given 6 months after the first one. France is still outraged over Australia's cancellation of a French submarine contract in favour of a defence deal with the US and the UK. The EU is now talking about a possible delay of upcoming trade talks with the US. France's EU Affairs Minister says it's all a matter of trust.
I would not say it has broken ties. I say it creates a difficult situation. We have to be lucid, we have to be aware, we have to be firm, not as French, but as Europeans, because it's a matter of the way we work together as allies that we remain, in particular between the US and the EU. So I'm first very happy that the President of the European Commission, the President of the European Council, the highest EU authorities have been very clear to say, including to our US friends, this is a European issue, and to open discussions.
France also has said that the dispute has put Brexit negotiations over Northern Ireland at risk. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex, Sky.
All right, thanks so much,
Ritika.
Ritika.
Thank you very much.
Jinx.
Okay, does that mean I don't get to talk anymore? Because that's what my children say. If I say something at the same time as them, they're like, you got to stop talking now.
No. It says it's Alex/Guy. I'm looking at Alex/Guy.
Okay.
That means I get to talk first, and then
a
you
mind
get to
meld.
talk.
I talk to the sci-fi story that you love so much. That French story is interesting. I tell you what, it's having significant repercussions. I'm not sure. It's going to be interesting to see how the rest of the EU reacts. It's been quite quiet, I think, from other capitals. The Germans, obviously ahead of an election, aren't really going to step into the middle of this one. I think they probably will make Brexit talks a little bit more difficult. I think relations with Australia are going to get a little bit trickier as well. It's going to be interesting to see how the US relationship works out. I am almost certain that the dropping of travel requirements the other day, earlier on this week, was a direct reaction to that. Because once you started to dig into that announcement, the details were really sketchy. They hadn't figured anything out in terms of the granularity. It was just like, we've got to do something, here's something, we'll figure out the details later.
Yeah, I have two feelings. So one is that at some point, are they just complaining just too much? Like, I mean, come on, it's business, right? Move on. And the other part is I feel like when President Biden was talking to the United Nations General Assembly, he was saying we can disagree on some stuff, but let's agree on a lot of things. And sure, you can make the case talking to China, and then they can agree on things like COVID and climate, et cetera. But I couldn't help but wonder if how much of that was also talking to France. Like, I get it. We're upset about the submarine thing, but let's all get it together on stuff that really matters.
Yeah, I think that it also highlights, I think, a bigger issue for the European Union, and that's the lack of heft when it comes to military reach and military capability. France is, to be honest, the only nation within the EU that now has significant heft. It is a nuclear armed power. It has made significant commitments to spending. It has commitments in various parts of the world, including the South China Sea, but more notably in Africa. And I think it's looking around thinking who else is going to be sort of stepping up here. Macron would like to see the European Union having a much more significant military presence, but Germany thus far, not so much. And you do wonder post this election whether or not that really is going to change.
Right, and what the domestic priorities are as well, particularly of how COVID winds up developing. And then you have the climate financing in all of that as well. Okay, the other main event, of course, that we haven't even talked about really over the last 2 hours. Isn't it amazing? Is the Federal Reserve kicks off their meeting today. They're going to be get the announcement tomorrow. And you brought this up yesterday that I wonder how the sell-off that we saw and the rollover that we're seeing today kind of impacts how a message is delivered. Not maybe the actual message, but how a message by Jay Powell is delivered.
Yeah, it's not a very big move thus far if you actually take a step back and look at it from the financial markets. Therefore, you do wonder whether it really changes the narrative. But central banks have been hypersensitive to this kind of risk. We'll talk about it more. Mike McKee's going to set us up. Looking forward to that conversation. This is Bloomberg. So what do we make of the price action? What's the technical setup? Let's find out. Abigail Doolittle has the details.
Well, Guy, I heard you and Alex debating whether or not it's tepid Tuesday or turnaround Tuesday. Right now, it's probably somewhere in between. We have the S&P 500 up about 0.4%. This, of course, after yesterday's big sell-off, but a sell-off that did put the S&P 500 back above its 100-day moving average. You see greater strength here for some of the big tech names. The Russell 2000 still a little bit below its 200-day moving average, but the last time that happened by the end of the day above. So we'll be, of course, watching all these indexes at the end of the day. Let's go into the Bloomberg terminal, though, and check in on the S&P 500 and its moving averages. So first of all, the thing to note is the beautiful uptrend to the upside. You see that consolidation down to the 50-day moving average, slicing, gapping below it through yesterday, but that 100-day moving average at the end of the day holding, telling you that those intermediate term buyers, they like stocks, they're buying the dip. Let's see whether or not that holds at the end of the day, Alex.
All right, thanks so much, Abigail. So maybe it will be turnaround. I feel like there's a thing, like Guy wants tepid, I'm looking at turnaround. We'll see how that goes. Okay, speaking of a catalyst, the Fed's two-day meeting kicking off today. More on what to expect. Bloomberg International Economics and Policy correspondent Mike McKee joins us now. Okay, Mike, we're all going to be looking for what it means to taper. What are the keywords we're looking at?
Well, today we're going to look at what Jay Powell's job is going to be. We can talk about the statement tomorrow, although that will be far less important than what Jay Powell has to say when he has his news conference. First thing he's got to do is talk to the public and Wall Street about growth and inflation, because inflation's too high, and you look at the Atlanta Fed growth forecast, and it's too low. It's coming in below expectations. So what's going on in the U.S. economy? Is there stagflation out there? Probably not, but it is something that people are starting to worry about, and of course inflation is a concern. Second problem he's got, talk about the conflict of interest concerns that have developed after a couple of Fed officials were reported trading a lot in the financial markets during the past year. Maybe there's nothing untoward about it, but it doesn't look good, so what is he going to say about it? And third is, what is he going to say about overall tapering? Does he talk about tapering and hint at it? And you see the T on the left-hand side there. That's when Ben Bernanke talked about a taper and then got the taper tantrum. You can see the 10-year yield. Or does he hint it's going to happen and everything goes smoothly like the last time that rectangle there took about a year? Are they going to do it faster?
We haven't talked about it much, but it's going to be the main event tomorrow. I can assure you of that. Mike McKee, Thank you very much indeed for the setup. So that is a good setup for the next 24 hours. What else are we watching? Well, clearly we're going to be paying attention to what President Biden is going to be doing. He's got a series of meetings coming up. I think there's one taking place right now with the fellow from Down Under, the Prime Minister of Australia, Scott Morrison. We're going to be seeing a meeting a little later with Boris Johnson, the British Prime Minister. I think they're going to DC for that meeting. FedEx after the bell as well. Is it after the bell? We got FedEx earnings definitely tomorrow. I thought it was after the bell. I could be wrong about that. But pay attention to that because the whole transport logistics story, really important right now.
Yeah, and then speaking of earnings, I'm really excited about General Mills tomorrow because Kroger, for example, had a lot of insight on how high inflation they're going to be looking at, where they're seeing it, how they're passing it on. General Mills, which is dealing with all of these input costs, is going to be front and center in that. And then, of course, you got the Fed. We all know that. You also have the BOJ rate decision as well. So I said 13 central banks this week. We get about six major ones. So 2 of them tomorrow. Yep. Nothing to sneeze at with that. They're upset for me and Guy on TV here. Libby Cantrell, PIMCO head of public policy, will be joining Balance of Power with David Weston on Bloomberg Television and radio. And Guy, we're still going to radio also.
Yeah, we're going off to the cable. We will be discussing what has happened here in the UK today, Turnaround Tuesday, plus also that green gilt deal. That's coming up. This is Bloomberg.